extremely bullish on gold. If I'm wrong about that, even the Fed is saying it's going to cut this year. That's bullish for gold too. So it's either bullish for gold or really bullish for gold. I'll take that trade. The macro thesis for gold is so skewed towards the bullish with this enormous support from central banks, no less. And then also whoever the new buyer is this year, whether it's Chinese retail or India, I think global portfolio allocation is starting to make that famous Rick rule shift from 0.5 back towards the 4-decade mean of 2%.
Strong central bank buying and safe haven inflows amid growing geopolitical tensions have boosted demand for gold, helping to drive the price up more than 25% since October. Despite central bank gold buying slowing moderately in the second quarter, it set a record through the first half of 2024. In the second quarter, central bank gold demand totaled 183 tons, according to the latest data compiled by the World Gold Council. That was up 6% year-on-year, but about 39% lower than the Q1 buying pace. China primarily drove the Q2 slowdown in central bank demand. The People's Bank of China reported no additions to its gold reserves in May or June, and only officially added 2 tons in April. Despite headwinds for gold and reduced buying from China, gold prices remain robust, indicating strength. Gold surpassed $2,500 per ounce for the first time in history on August 2nd, in the wake of rising geopolitical tensions and new data indicating a weakening U.S. economy. Lobo Tiggre, analyst and editor of The Independent Speculator, remains extremely bullish on gold. While he refrains from predicting specific numbers, he believes that starting from $2,300 or $2,400, the sky's the limit for gold prices. Looking at the dollar, the global financial landscape is undergoing a subtle yet significant transformation. At the heart of this change is the concept of de-dollarization, the gradual reduction of the U.S. dollar's dominance in international trade and finance. By March 2024, over half, 52.9%, of Chinese payments were settled in yuan, marking a remarkable doubling of its share in just 5 years. Recent data shows the dollar index is up 0.36% to $103.241, driven by strong U.S. economic data expectations. Tiggre is not worried about a resurgent dollar, as gold has historically shown strength even in high-dollar environments, especially during times of geopolitical tensions. He believes that under certain circumstances, both gold and the dollar can rise simultaneously. Overall, Tiggre remains bullish on gold regardless of the economic conditions and ongoing debates among economists. Before we explore further, be sure to subscribe and click the bell to stay tuned for more engaging content.
So first, I see a floor, if you will, not a technical floor, but support from the central bank buying, the global south. China's taken a break, and we're still near nominal all-time highs. It really tells me that this is robust. So I don't want to say never say never, but in a world where there are headwinds for gold and China stopped buying, right? And still gold doesn't melt down. That's a lot of strength. It makes me more confident in being, more aggressive in my buying. I just don't see that much risk in buying gold stocks now. I mean, the macro thesis for gold is so skewed towards the bullish with this enormous support from central banks, no less. And then also whoever the new buyer is this year, whether it's Chinese retail or India, I think global portfolio allocation is starting to make that famous Rick rule shift from 0.5 back towards the 4-decade mean of 2%. So I think there's real sustained buying that doesn't just go away tomorrow on a headline of a Fed rate or an employment number unexpected or whatever. The things proceed as the mainstream expects. Well, the mainstream expects 1 or 2 rate cuts this year, which is bullish for gold, starting from a $2,300 or $2,400 base. That's very, very encouraging. Now, if I'm right about Team Hard Landing finally having their chance at the victory lap, by the end of this year, well, then we're not just talking 25 basis points in September. We're talking much bigger cuts. We're talking stimmy checks. We're talking the whole money helicopter gamut. I think that's extremely bullish from gold. And again, starting not from 1900 or 2000, let alone prior prices, starting from 2,400.
Sky's the limit.
Well, yeah, I don't even want to spit out a number because it's embarrassing. I think I have to wear a tinfoil hat to say. But just think about the kind of
Citibank said $3,000, so maybe I don't know. It's like
think about the headlines. Here's a data point: when Newmont beat on their, and I'm not a Newmont shareholder, I'm not promoting Newmont, but it is the world's largest gold miner right now. So when Newmont beat on their Q1 financials. That was headline news, not just at GitGo or SOAR Financials. That was headline news on Yahoo and on Bloomberg and mainstream finance media, because it's the world's largest gold miner. Gold's up, it's in the news. The largest miner beats on their financial guidance. So, and by the way, what a great beat. But they beat, right? So that became headline news. I was really, maybe not shocked because it should have happened, but I was really powerfully stricken to see these people who seemed like couldn't even pronounce gold. The end of the dollar is inevitable. I will stipulate that. Doesn't mean it's going to happen this year. Didn't mean it was going to happen last August 24th when the BRICS adopted their gold-backed currency, which didn't happen, right? You know, people get all excited about all this stuff. That's inevitable, but it's not imminent. So my answer to this is, I don't know if Joe's right or wrong. I don't know, when Brent will be right or wrong. I know that the gold dollar exchange rate is near nominal all-time highs, even while the dollar is showing strength. So I'm not worried about a resurgent dollar this year. I think everything else is bullish for the dollar, even in a high dollar environment. We're in a high dollar environment right now, and we're looking at high gold dollar. And there are times, and the most obvious times are times of war. When Russia invades Ukraine, for example, it's a hobby of theirs. They do it from time to time. You'll see gold and the dollar go up at the same time. That's the fear trade, safe haven trade, right? And I think it's a mistake to see the dollar as a safe haven. But at that moment, sure, I get it. So that tells you that it's not like this cosmic law of the universe that the gold has to go down when the dollar goes up. Under correct circumstances, when the market perception is such, the behavior is such, the dollar and gold can go up. And one could argue that even without some new war in the universe, that's happening right now. We're seeing strength in both. So I guess my answer is, I'm not worried about it. I'm bullish on gold regardless. And I'll let the economist argue about whether or not Joe's theories are.
The Fed's long-awaited interest rate cut, a move that's likely to juice the U.S. economy and stock market, may be just weeks away. The Federal Reserve held its key interest rate steady again Wednesday, but signaled it could start lowering it as soon as mid-September amid easing inflation and a cooling job market. In the market's eyes, the Federal Reserve finds itself either poised to head off a recession or doomed to repeat the mistakes of its recent past, when it was too late to see a coming storm. Practically speaking, Tiggre suggests that if the economic unraveling continues, the Fed might not just make 1 or 2 rate cuts as currently expected, but could execute a real bona fide pivot. This would have huge implications for gold and other monetary metals. Now, let's delve into the video.
The long and variable lags are finally starting to wind down. And it's an interesting thing that there's been so much talk on the team soft landing side, which was earlier this year morphing into team no landing. And now it's kind of changing back into soft landing again. It's funny. You see on mainstream financial media people saying, instead of dismissing that there's going to be any recession at all, it's dismissing that we're going to have a hard landing. That's now the objective. The goalpost has moved. So the conversation has come back to this recession question. First and foremost, the long and variable lags, the average in the U.S. between the beginning of a tightening cycle and a recession is 27 months, plus or minus, which means more or less right now. So all these people who said we haven't had a recession by now, we're not going to have one, they're simply historically ignorant or dishonest. That's just not true. Starting this month going forward, if we don't have one, it starts getting late. Now, post-COVID and all the strange things that happened and market alterations then, it's not really strange that we should have a delay, right? Not a lickety-split thing. The labor market cracks. It's not just like, we got a first surprise. This is now the second month of weakening data, and seriously weakening data. And the consumer side too, that laborer/consumer, the spending, the retail sales number was a disappointment too. So we're having now, it's not just a bad report. We're having now a series of bad reports, multiple data fronts. And this is the government's most optimistic data. This isn't like some shadow stats number. So yeah, I think that we are now getting to that point where those long and variable lags are starting to be done. We're starting to see the labor market weakening. We're seeing consumer behavior changing. And this is a big deal for the U.S. economy. I'm talking about this recession, and it keeps not happening. People are like, Lobo, you're wrong, or where's this recession? I think I will be shown to be right this year. I think we'll start seeing more data, like we're seeing it now. I think we're seeing the beginning of it now, and it will continue unraveling this year. In terms of practical takeaways from this, okay, economics, whatever, Fed, let's start with the Fed. So if I'm right and the thing starts unraveling, I think we see not just the one or two cuts the market is now expecting. I think we see a real bona fide Fed pivot. And that is huge implications for gold, monetary metals.
Gold prices hit their highest in over 2 weeks on Friday, August 2nd, as Treasury yields and the U.S. dollar declined after data showed the U.S. economy created fewer jobs than expected in July and U.S. manufacturing activity shrank. This lifted Wall Street bets on upcoming rate cuts by the U.S. Federal Reserve. Increased expectations of a U.S. recession and interest rate cuts buoyed gold prices while denting the dollar. Gold prices are forecasted to average $2,500 in Q4 2024 and $2,600 in 2025 by J.P. Morgan, driven by geopolitical tensions, expected Fed rate cuts, inflation, and central bank buying. What is your stance? Your opinion matters. Drop your thoughts in the comments, hit the like button if you enjoyed this, and subscribe to stay informed on our journey together.